So these are the services that we offer. We also do corporate training, market research, and generally we like to work with retail investors. We try to be as available as possible to them and engage them so that they can feel comfortable before they get to start investing. So this is our 40th masterclass, and we are celebrating it with all of you who are here and those who have been into Abojani masterclass. So today I'll focus only on the personal finance value chain. So those who have been into our masterclass, I believe you are aware about this, but the reason we came up with it, we realized that it is very easy for us to only have a very, very linear view of what wealth management is all about, what personal finance is all about. And we keep on seeing a lot of issues. And sometimes you wonder, you find that maybe there's a rich family that they seem to have it all, but they're still having money issues. So some of the reasons why those issues occur are in this slide, and I'll take you through beginning from financial planning. So financial planning, our philosophy is always that personal finance is very personal. So you start with you are the business. When you're talking about a country as Kenya, that is Kenya. When you're talking about a business such as Safaricom, that is Safaricom, or even your startup. But when it comes to your personal finances, you are the business. So basically it's about planning for sustainability of your finances. And these finances are supposed to help you with your life goals, the things that you desire, the things that you want to achieve in life, so that in the long run, you can feel like you are living a fulfilled life. So it's very, very important that you plan with what you have. And that starts with the ability to create value. Then you'll be able to earn some sort of income. Then that income, you can use part of it for your personal needs, a bit of it for fun, then the rest for saving and investing in the long run, because that is what will help you when you want to retire or when you want to buy a car, start a business. So it's very, very important that you start from there and make that connection. So we usually say that this value chain is like an empire, is a kingdom, and we have to try to protect all borders because you don't know where the enemy will come from. Then we'll go to wealth management and investing. This is the most popular part of personal finance and is what is normally assumed to be personal finance in general. But you'll come to realize that as you invest and as you save, as you get your dividends, you might need to reinvest them. And part of it, you might need to use to pay some insurance premium. You might need to take some medical insurance if you're an entrepreneur and you don't have a medical cover, it will come in handy. So risk management comes in after wealth management, and it helps you basically with managing non-risks. So there are some that are mandatory, like if you own a car in Kenya, you are required to have some sort of insurance. Then there are some that would help you with protecting your wealth. So if you look at medical insurance, if you have inpatient cover, it could help you in case something happens and you are admitted, it will carry the burden on your behalf. So it's always important to make the connection. So wealth management is mostly about investing, and Paul will dig deeper into that using the stock market as one of the vehicles. Then after risk management, we are looking at retirement. So the concept of retirement is just the life cycle that you have, that over time, you want to be as smart as you are now, or you want to be as active as you are now. So basically you'll be saying that your human capital will be low. So that's the time that you need the financial capital to take care of you. And it's very, very important that you make a connection with that. And once you make the connection, then it becomes natural in terms of your savings and investing, because you are in a journey that you made a connection with. And currently the statistics are that about only 13% of people who have attained retirement age can take care of themselves using the pensions or other sources of income. So for the rest of them, maybe they're relying on relatives, children, or they have to do certain odd jobs to keep them going. So you can picture that and try to position yourself in a situation whereby when you reach the retirement age, you'll have financial capital to help you with your life journey. Then you have debt management. So debt management is key. So looking at where things can go wrong again, debt, when well managed, can help us do a lot of things, but it is always a weak link. There's very high correlation with having unsustainable debt and having personal finance issues. So that one, the guidance is usually you should try to ensure that you don't spend more than 15% of your net income on debt management. So worst case scenario is 25. So it's called debt to income ratio. So if you can try to put it below 25%, then that might work for you. But again, before you take any debt, you should ensure that it is something that is going to be useful in your personal finance journey. Yeah, then home ownership. Yeah, so home ownership, this is one of the biggest expenditures that you're going to have in your life journey, and it's always good to plan for it. Yeah, so from my experience, since we've interacted with over 5,000 individuals when it comes to personal finance and investing, the issue tends to start between age 15 to age 50 there. Sorry, age 35 to age 50. So we have what we call home ownership bag, where you just wake up today and you feel like you want to own a home in the next 2 minutes or 2 days. Then you end up making the decisions that you'll come to regret maybe 5 years from now or 10 years from now. So because of that, you need to plan and look at the different ways of owning a home. So do you want to buy a piece of land and then develop a property in it? Do you want to take a mortgage? Do you want to raise the down payment, then take unsecured loan? So look at the options that are available and which one would work best for you. And also look at household affordability, which basically says that when you look at the household income when you look at the amount that you're using to pay for your home, whether it is rent or mortgage, over total household income, we should try to ensure that it is below 35%. So the lower the better. Again, if you stretch it, it might bring issues. Then number 7, the elephant in the room, which is key. If you want to create sustainable wealth in our ecosystem, we need to passing wealth across over to the future generations. So that is looking at your lineage and seeing what you can set aside in terms of tangible and intangible assets. So it's not only about money, but even the things that you've learned that have helped you in your life, like if you know how to write a good CV, if you have sales and marketing skills, or good habits such as integrity, being a person of good character or high integrity, you need to pass them down into your generation. So it's very, very important that you look at this. And this is what will now create wealth and catalyze entrepreneurship and corporate here in Kenya. So it's very, very important that we make a connection with this and know that asset administration is like a bridge connecting us to the future. So if you are in Nairobi and there's a bridge at Ngara, you're able to go to Thika because someone built that bridge. So what do you want for your lineage? So again, that's very personal. And as a Bojani, we are really encouraging people to also define success in your lineage as one of the highest forms of success. Because we have a lot of definitions of success. It might be being in top 40 under 40. It might be serving 2 million customers, 40 million customers, and you might end up forgetting your own lineage. But if you help your lineage succeed, if everyone does that, then collectively, you'll have a better ecosystem. So this part is key, just ensuring that you protect wealth, you have a way to transition it within your lineage. Then finance for kids. So kids, when you look at finance, most of us who are here probably, we didn't get to know about personal finance and investing at a young age. And now for us to change what has been happening is to start now with our children to ensure that they're well knowledgeable when it comes to matters budgeting, saving, investing, and also involving them in what you are doing. If you want them to, at a certain point, be part of your business, you need to start now. Because you might be shocked that one day you'll have a lot of money, you have a big business, and they're not interested in it. So start engaging them now so that they just grow with it and it becomes part of their lives. Finance for couples, very, very important because as a couple, these are two people from two different backgrounds, and it's important that they find a rhythm so that they can grow their finances together. And finance can be a very, very big problem if not well managed in the family. And consolidation of wealth helps. So if you look at societies that have developed, you'll always find that they have a level of interdependence. So interdependence is actually the highest form of socialization. So you have dependence where some people want to be taken care of. Then you have independence where someone assumes that they don't need anyone in the world, like everything they can do by themselves. But later on, you realize that all of us, the internet that you're using to connect now probably is from Safaricom. So however smart you are, you'll always need things from other people. And you find that at that layer, things will happen because of the networks that you have. And it's important that at the family level, you try to create some level of interdependence. Then career development and entrepreneurship, very, very key. So they're also part of personal finance and investing, because actually here is where most of our income for investing and saving will come from. So we need to nurture them when budgeting, budget on how to grow your career, how you're going to be flexible, and ensuring that you remain relevant and valuable in your industry so that you are the go-to person. So that will naturally give you more opportunities to earn more, whether it is through a promotion or changing jobs. So that's very key. So even for your business, do you need digital footprints? What do you need? What new skills do you need to learn so that the cash flows of your business can grow, and indirectly you'll be able to pay yourself more and build your personal finances. Then finally, taxation and tax principle. So that one, I believe we have a general idea of how important it is, and it's always important for all of us to ensure that we don't have any issues with the tax one. Yeah, so when you look at this value chain, you'll find that in most cases, they're interlinked. They're interlinked, yeah. And sometimes there are confusions that arise from the different value chains. So some people might assume that their retirement package is for building a home. So once they build a home, now they have no money for retirement. So because of that, it should be planned for independently. Yes, they can interlink. Like for example, if you get some dividends, they might help you for furnishing your new home, but you should always know that they're interlinked and not just focus on one at the detriment of others. For example, if you are into too much debt, you might not have enough money to pay for your insurance premiums. You might have issues with your spouse if you are married. You might not be able to take care of your children. And having too much debt again can affect your career. You might not be in your best form at work. So it's always important that we at least should be aware of them, then plan to work on them through our life journey. So thank you very much. I'll stop at that point and then invite Paul for the next presentation. Thank you.
Okay, thank you, Robert, for that very informative presentation. I just want to applaud you for the really good work you're doing on investor education and creating awareness of the importance of savings and investments and providing Kenyans with that opportunity to grow wealth and prosper. I think it is a very important job that you do, and a very necessary one if we are indeed going to grow our country and our economy. So my part today will be to talk about investment in the stock market, and particularly investing in shares. So I'm going to address 4 main basic questions. The first question I'm going to address is why we should invest in shares. The second question I will address is what's the best time to invest in shares. I will then look at I'll then look at what could go wrong when you invest in shares, so that you're aware that certain things could go wrong along the way and how you can look at it and mitigate it. I'd look at what shares you can invest in the stock market. And finally, I'll answer the how question and the process that you need to go through to invest in shares. So the first question is, I hope you can hear me loud and clear.
Yes, we can hear you, Paul.
Yes, the first question is with regards to why why invest in shares. So a number of points come to mind. The first of all is high return through capital appreciation. So shares prices move. If we take the example of Safaricom, which was listed in the stock market in 2008, has been in the market for the last 12 years. The price has gone up from 5 shillings and 25 cents at the issue to the current price of 29, and has at even one point gone as high as 45 shillings. So you can see that over the years, the price has almost grown 5 times in the last, 6 times in the last 5 years, and could even have grown much, much more. It's just that currently, during the current market, the price has come down significantly, and that's why we've lost some of that gain, and I'll come back to that. The second point is liquidity. So liquidity is the ability to convert an asset into cash without the loss of value. And shares give you that advantage of liquidity. I think many people who had invested in plots or in land, and when they got into problems during the COVID period, they went to try and sell their land and realized that it is not a very liquid asset. It takes you about at least 6 months to a year to sell your property asset. With the stock market, it takes you only a week and you'll have the cash in your bank at the most. It could even be faster. The next thing is bonus shares. So when a company accumulates reserves of, it makes profit and doesn't distribute it, after a while, it has the option of giving shareholders a bonus share. And those are only entitled to those who are current shareholders. So it's an added advantage that you could start with a certain number of shares and end up with many more shares, even as the share price continues to increase and rise. So the next thing is dividend. I mentioned that, we have shares paying dividends as high as 10% on some of them, 10%, 15% on some of the whatever, which is fairly good return, considering that you're not only getting that dividend, but also the possibility of a capital appreciation. You can see that, if you put your money in a bank deposit, you will get maybe 8%, depending on the amount of money you have, maybe even as low as 3%. But there is no possibility of that increasing in value. But a share is giving you that dividend as well as the capital appreciation. So when you get that kind of a dividend, I think it presents good opportunity. The next item is that shares also, you can use your shares as collateral for a loan. So you can pledge them and borrow against them. But more importantly, with shares, the process of pledging and unpledging is so much easier than that of land and other assets that we use to borrow with. So it doesn't take as long and it's not as expensive, because if you want to pledge land, you need a lawyer who would have to put a charge on that land, and a very, very rigorous process. It's almost as difficult as purchasing or selling a piece of property. And the shares is a much, much simpler process. The next item is that you get involved in the annual general meeting, and you get a chance to meet the management and challenge them on the decisions that they are making. And that's an important right that you can get. The next advantage of shares is on estate management. And I think Robert has touched on the importance of estate management. If you look at most disputes that go to the courts with regard to estate management or the passing on of wealth from one generation to the other, almost 95% involve land. Very, very few, if any, will involve shares. The reason being that shares are very divisible and they're very easy to distribute. So they perhaps help you in terms of your estate management. And finally is the issue of compounding. Now, compounding comes in 2 levels. For a company that's generating very good return and is retaining that profitability to generate even higher return in the future, the share price will rise significantly. And that is the effect of compounding. So compounding is when you get a return and you reinvest it so that you get further compounding. So compounding can happen within the company, where the company is making profit and reinvesting that profit and growing and continuing to grow the asset base. Or it can happen for yourself. So when you're paid that dividend, you reinvest it back into buying additional shares into that company, then gives you that effect of compounding. And that is perhaps one of the reasons why you see most people over the years have grown their wealth significantly. And you wonder, I knew this guy only 10 years ago. Now I can't believe how much he has. When you invest and you compound that return, it really makes a significant difference over the years in terms of how much wealth you accumulate and are able to grow. So we've shown there some of the share prices that have gone. Obviously, we are going through a very, very difficult period in the stock market, and you can see almost all of them heading south. But over the years, you can see there's been certain ups and downs. Now, let me now go to the next question. When is the best time to invest in the stock market? So I've shown there a graph that starts in 1992 up to the present and shows you the kind of fluctuations that we've seen over the years in the stock market. And I'll perhaps just touch on that and just look at what opportunities they present. So we will start in 1992. I know some of you might be a bit younger than 1992, but I can just explain that in this time, if you remember in the 1992 elections, those who are older, this is the time when we had the 500 shilling note called Jirongo, because there was accusations that the government was printing money and there was too much money in the economy. And that money also went to serve to fuel the stock market boom. Very similar to what we had in the US when we had a very aggressive or very not aggressive, a very loose monetary policy during the COVID period, a lot of stimulus, and people had so much money, they were buying Bitcoins, they were buying shares, and the stock market rallied. Everything in the US was going up. But then in 2000, after the election in 2003, inflation also shot up very significantly, fueled by that additional money supply. And the government had to take very stringent measures to pull back that extra money. And it issued treasury bills at very, very high rates, as high as, I think at one point, the highest T-bill was issued at 93%, an annual interest rate of 93%. And that served to pull back the money, but also created perhaps one of the worst recessions, if I could call it that we've ever had, that lasted from almost 1995 to 2001. 2002, we had the NAC government come into power. And one of the first things that the Kibaki government did when they came to power was to reduce the cash reserve ratio and expand monetary policy. So the cash reserve ratio is when a bank takes money, it has to reserve about 5% or with the central bank that it cannot use. So Kibaki reduced that to about 3%, which meant banks had a lot more money that they needed to use. So banks had to go out there and start lending. And I think at that point, banks were setting up tents in the streets, selling loans because of the relaxed monetary policy. And that again served to fuel another stock market boom. Actually, there we are showing 100% return based on the NSE 20 share index. If you looked at the Nairobi Securities Exchange all share index, the return was actually 22%. The difference being that index is weighted towards the bigger shares. The return was actually 200%. In that period, you didn't have to choose shares. Anything you put your money in went up, and it was perhaps 2003. The return was over 200% for some of the portfolios that we were managing at that point. So again, these things will continue to happen in the future. They have happened in the past, and we believe there's still opportunities. Again, we went to 2007, 2008, where we had post-election violence, also accompanied by the global financial crisis, which also saw share prices come down. We had interest rate caps in 2016, also affecting share prices going down sharply. We had COVID-19 also affecting share prices coming down sharply. The message there is that there's opportunity in every crisis. If you if you ask someone to buy shares when the COVID-19 crisis hit, they would have told you you're out of your mind because everybody was selling. So making money out of the stock market needs you to be a bit counterintuitive. And sometimes you need to be buying when everybody else is selling and selling when everybody else is buying. When you see people being very, very excited about investing in the stock market, I think that's the time you need to be a little careful. So this declines, and indeed the current decline that we are having also represents an opportunity, particularly this particular decline, because it is caused by factors that are out that do not necessarily affect the fundamentals of the shares. If you looked at the banking crisis, it was going to affect the shares of banking sector stocks. That's why we had a decline. But this particular crisis is perhaps more to do with foreign investors selling off on the Kenya market because, one, they are moving out of frontier markets, maybe a little of panic following the default by Sri Lanka, the war in Ukraine, and there's also the factor that interest rates in the US are going up, so foreigners are moving money back home. So it has nothing really to do with the fundamentals of Kenya as a country or with the fundamentals of the actual companies. So if we take the example of Safaricom, it's still selling airtime. It is M-Pesa is still growing. The expansion into Ethiopia is unaffected. But yes, the share price has come down 23% year to date. So that to me represents a very clear opportunity. And that's why I said when answering when question, then you look at points where you are seeing significant decline in market prices that are unrelated to the fundamentals of the company. So what could go wrong? The next question. So first of all, there is the market risk. So and part of what we are seeing right now is market risk. Share prices go up and down. Sometimes because of the actual share having issues, sometimes the overall market coming down, the systemic risk of the market. And so that happens from time to time. The way to mitigate that is three ways. First of all, to make sure that you diversify, so you don't put all your money into one or two shares. You've got a basket of shares, so that if one is affected, then the other one is whatever. But also diversify across assets. So don't put everything in land. Don't put everything in the stock market. Don't put everything in bonds. So diversification where you have a portfolio with a certain amount of money in different asset classes will help you mitigate market risk from time to time. The second thing you need to do is to make sure that the shares that you buy are well researched and well understood, so that you're investing with shares with strong fundamentals. And the third thing is to have a long-term view. So you need to be able to wait at least 2 to 3 years. In the event that there is that decline in the market, you must have the patience to wait it out. Otherwise, you'll be forced to sell at a loss. And therefore, when you're looking at money that you want to invest in the stock market, don't look at money that you're perhaps looking to buy a house in 6 months or to pay school fees in 6 months. Then you say you want to go and play with it in the stock market for a while and then bring it back. That you could very easily be affected by market risk. The next thing is business risk. So businesses go through risks. So if we take the examples of Kenya Airways, Uchumi, Mumias, I think there are numerous examples, Athi River Mining. All those are companies that were in the stock market but went through certain challenges from time to time, which resulted in their share prices coming down significantly. Again, the key thing here to mitigate this is to tap into proper researched companies whose fundamentals are sound. And our research team produces research reports on most of the companies that are of investable quality in the stock market. Take time to read the research and understand it. Also check, the key thing here is you want to avoid companies that are very highly leveraged, because the higher the leverage, the higher the risk, and also which don't have very strong business fundamentals. The other things that go wrong is the regulatory risk. I think the biggest example of this was the interest rate cap, which affected banking sector profitability in a big way, and we saw the share prices come down and also profitability be affected, at least in the short term. I think they have since recovered, but their profitability was somehow affected by that regulatory risk. And the next one is the socio-political risk, which I think we all know, the geopolitical situation, the war in Ukraine, and things happening around the world that could affect the stock market in general. And again, the key item of mitigating this is provide for diversification across various asset classes. We've highlighted some of the best performing shares in the market. I think for me, the decline in Safaricom of 23% represents an incredible opportunity, but also in any other shares. So we'll just to highlight what comes. So what to buy? So those are some of the shares that we would recommend, and our research department produces a stock recommendation report on a monthly basis, which highlights each the key investable shares and grades them as a buy, sell, or hold. So a buy is one that represents significant upside or some upside. So based on their analysis, they say that they foresee that the share is likely to go up in the next 6 months to a year, and therefore they would label that a buy. Some maybe might still be good, like Standard Chartered. The fundamentals of the share are strong, but the price has gone up to such an extent that we then downgrade it to a sale, because we see that it has been overbought and there is perhaps room for a correction or in the price that will result in the price coming down somewhat. So in terms of this is only an example of what we have at the moment, but we're happy to share with you the current stock recommendation report, which you can then go through the whole list of the shares that we would recommend, and you can be able to follow that. We also have a model portfolio, which is covered on that stock recommendation report. So that model portfolio, we also compare it with the index, the NSE 20 share index and the NASI and Nairobi Stock Exchange share index, so that you are able then to see that how is this particular model portfolio performing against the index. So that's what. Now let's go to the how. So the how is what we do have is we have the AIB DigiTrader app or online solution. You can open your account on that account and then be able to trade on the Nairobi Securities Exchange quite easily. So you're able to log in, open your account. We then cross-reference that with the national database of IDs from the IPRS, and within 24 hours, you have an account open. You can fund your account through M-Pesa. You can also fund your account through Bonga Points and be able to start your investment journey quite easily right from the comfort of your home and be able to take advantage. So if you are a Safaricom subscriber who is holding Bonga Points, I think you are better off holding Safaricom shares at this moment than holding the Bonga Points, because the Safaricom shares will give you dividend and the possibility of significant capital appreciation from where I look at it right now. So you still maintained your loyalty to Safaricom, but you have something now that can appreciate in value, but also give you significant dividend over the long term. So that's the highlight. There's a small video here.
Do you want to start investing in local stocks today? Listen in on how to open an AIB DigiTrader stock trading account. Opening an account with AIB DigiTrader is quick and simple. Just a few steps and you can begin investing in no time. Here's how. Download the AIB DigiTrader app from all Play Stores. Click Open New Trading Account. Now to set up your basic account information. Your names, ID number, date of birth, nationality, email address, mobile number, and either your ID or passport number. If you were referred by someone, put in their code. If not, let's continue. Almost there, only a few more easy steps to go. Put in the last of your personal details, including your postal address, your payment details, and your preferred username and password. 2 important details. When putting in your address, ensure you put in your town. Under bank code, start typing the initial letters of your bank and you should see a helpful drop-down. Document uploads are optional. Now click Submit. You'll get an automatic email confirming your submission. After your successful submission, you will receive your CDSC number via email in just 24 working hours. And you can now trade anywhere and at any time with AIB DigiTrader, your #1 trading platform for local stocks.
All right, so I think we can move on to the Q&A session. There are quite a few questions, and I think we can jump right in due to time. So the first question is, I think, to Robert. And as a young person, when is the right time to start retirement planning?
Thank you very much, Naila, for that question. So I would say that since our earning or revenue sources are not unlimited in this world, but we'll always have the need to spend on rent, food, and stuff like that. So you start planning for retirement immediately you start earning money, because actually that's when you have the biggest advantage. And the whole idea of retirement these days, actually you can create your own retirement age. And when you start it earlier, the better for you. Because again, if you say that you'll start at a certain age, these days you don't have a lot of permanent jobs like you used to have before. We've seen even governments is employing people on contracts. So always start, as long as you're earning, start from that point and just be consistent.
Okay, great, thank you. And this one is to Paul. Someone is saying every time they look at their portfolio, they worry because many of the stocks are doing badly compared with the buying prices. And is the market expected to change for the better in the future?
Yes, that's a good question. Yes, so the market is expected to change for the future. Obviously, one of the things we emphasize is that shares investing is a long term. And that's why I emphasize the importance of being able to invest long term, but also whenever share prices decline, you can do what you call cost pound averaging. So you're able to buy shares at lower prices and bring down your average cost to cost pound average. But over the long term, the good fundamental shares will come up. And also at the same time, when the share prices rise and you have some profitability, this also presents an opportunity for you to sell down some of your shares, not necessarily entirely, but to sell into the stress in the market so that you are able to realize some of the gains. Because sometimes if you stick on to shares too long, it'll come up, it'll show gains, and then it'll come back down if things change. But the emphasis is look for well-researched, fundamental, well-diversified portfolio, and look to buy at lows and sell at highs. So that's what I would advise.
Okay, and on that note, for someone who's a complete beginner, how do they know which stocks to buy and sell at the right time? Is there any assistance or guidance on this?
So thank you. Another good question. And I think the stock recommendation report that we produce on a monthly basis is perhaps a good starting point. We will produce that every month. And we would recommend maybe every month you look at the report and also look at your portfolio and see where you stand, and then see any updates that are there, but also follow the shares that you bought and see what reports are coming out of them in the market. so that they can inform your decision. So the best starting point is our stock recommendation report, which is produced by our research analysts who take time to research these shares and these companies, talk to management and understand the companies, analyze the risks of these companies, understand how much debt they have, how much opportunity they have in terms of growing their revenue, and they're able then to make recommendations based on those.
Okay, great. And are there any cost implications when investing in shares?
Yes, there is a cost implication. So the first cost implication is that there's a small account maintenance fee of 200 shillings for an online account. For an account that is not online, there's an account maintenance fee of about 1,000 shillings per annum. This is an annual fee, so it's an annual fee. And then there's a brokerage fee for the people trading online. The brokerage fee is at a discount of 1.3% on each leg. So if you're buying, it's 1.3. If you're selling, it's 1.3. If you are not online, then that brokerage fee is 1.5 on each leg. Thank you.
All right. And you had talked a bit about being able to take a debt on shares. And someone is asking, they would like to know how they can use shares as collateral, and is it with specific banks?
Yes, I think yes. I think if you go and talk to your bank and told them you have shares and you'd like to borrow against them, they would be able to arrange for that pledging. They would then get hold of your broker and have those shares pledged. So yes, it is possible to use your shares as collateral. I know it's not a very good practice. It's not a very widely used practice. I think perhaps the banks need to understand a little more. And also banks are a little, the people in the banks don't have a very good understanding of the shares as well. Because you can imagine if you pledged your Mumia shares as collateral, and then it goes down. So banks are a little sensitive about lending against shares because they need a very clear understanding of the underlying asset, which could have price fluctuations. But also what they would normally do is then maybe take your portfolio, but also maybe give you about 50% or 70% of the value of your portfolio. Yes, so there are people who have borrowed against them, but it is not a very widely used practice in this market.
Okay, and Gerald is asking, what is the minimum amount of shares that can be invested on AIB DigiTrader? And he also asks about Bonga points and how many Bonga points do you need to have to be able to convert them into shares?
Okay, so the stock market has this thing which they say that the minimum lot of shares is 100 shares that you can trade on the stock market. But they also have what they call the odd lots market, which is for lots below 100, which you can also be able to buy. So effectively, there is no minimum, but because of the cost implications of the 1.3 and the 200, I would perhaps propose you have at least 3,000 shillings for it to make sense for you to invest in the stock market, preferably slightly higher. I don't think you can redeem any amount of Bonga points to shares. I think there is a conversion ratio of I think 1 shilling for every 4 Bonga points that you have, and you can also redeem Bonga points and add on cash. So there is no real limitation as to how much of your Bonga points you can use to buy shares.
Okay, and a few more questions in the last 5 minutes. Paul Eva is asking, what would you recommend in regards to portfolio allocation in terms of capital growth and dividend stocks, and also how to reinvest the dividends?
Okay, all right. That's a good question. I think currently in our market, we have quite a number of very good some of the best stocks are the ones that are highly mature stocks and high dividend payers. And they also, unfortunately, at this point, represent perhaps the best opportunity for growth. If you look at what has happened in the last few months because of the sell-off by the foreigners, the key shares that have taken a beating from foreign sales are the big shares, Safaricom, KCB, Equity, which are the ones that are in the MSCI Frontier World Index. I think Coop Bank and those others. And when you think of when the foreigners come back, they will also go back to those same shares. So they will also be coming back. I don't know how long it will take for them to come back, but I'm sure at one point they come back. But they'll come back and push those prices probably right back where they came from. So in this case, you have a unique situation where the high dividend yielding shares are also perhaps the ones that show the best capital appreciation prospects at the moment. But I would recommend that you balance depending on your risk appetite. You should have at least 50 to 70% of your shares in low risk, stable, high income dividend yield shares, and also maybe about 30% in growth shares. How to reinvest your dividend? I think there is no harm if the share, again, as I said, we give a stock recommendation report, which then gives a recommendation of buy, sell, or hold. So once you get that dividend, there's no harm in looking at that report and saying, although the dividend came from Safaricom at the moment might not be a buy, so I'm going to put that money into another share. So the best example is Standard Chartered. Standard Chartered paid a very high dividend of almost 15% dividend yield, but it's still a sell at the moment. So we would not necessarily recommend that you put it back into Standard Chartered. You'd probably be better off going to KCB with that money. So it's think of your portfolio, plow back your dividend into the portfolio, looking for where you will see the best opportunity.
Wow, great answer. We also have a question from Melvin. For those with little income, what are the best ways to invest with a high return? Would you advise investing gradually in one company or diversifying the income in various companies?
Okay, so I think you can start slowly with one by one companies. So as much as possible, just start with one company and keep building. And think of it as a long-term journey, not a short-term journey. So maybe once you've gotten to a certain threshold on the first share, then you can move to the second share, third share, fourth share. This should be a long-term journey. So don't be impatient and whatever. So you can build it slowly by one, knowing that you have to build a portfolio. You're not going to stick to that one share. So after you reach a certain threshold, you say, now I want to add another share and another share. There's nothing wrong with that.
Okay, and I'll take two more questions. So one of them is, can you kindly repeat how to buy shares using Bonga points? Okay, so you dial *126#. That's the USSD if you want to invest in Bonga points, shares using Bonga points. Select Lipa na Bonga points, put in the pay bill, and as the account number, you'd put in your CDSC number. Then simply enter the amount of cash you want to convert, and then enter your Bonga points PIN. So 10 Bonga points is 2 shillings on Safaricom. So after dialing *126# and using these various points, you'll be able to convert that money into your trading account and buy shares. If you don't have a CDSC number, you can open an AIB DigiTrader account and receive your CDSC number within 24 hours and then go through this process through dialing *126#. All right, so I'll take one more question because of time. And most people are asking about the stock recommendations. So you can find our stock recommendations on our website. And if you join our Telegram, we also give weekly stock recommendations of what shares to buy and sell. All right. And okay, someone is asking, can you invest using a joint account? And also, can you invest if you're not in Kenya? Can you open an account if you're not in Kenya?
Yes, so long as you're a Kenyan citizen and you have an ID or a passport and your records are in the database of the IPRS, you are able to open an account and trade even when you're not in Kenya. The only challenge, small challenge, might be to do whether you have an M-Pesa way of funding the account, but you can still fund your account by making a transfer and sending to us the confirmation of the transfer of the money that you have transferred. So if you are outside the country and you don't have M-Pesa, that might represent a small challenge, but not a big challenge. Whether you can open a joint account, unfortunately for the online, we don't have the option for joint accounts online. So to open a joint account, you'd have to do the manual process of filling in forms and providing the regular KYC, which is a copy of a utility bill, your ID, and a copy of evidence of your bank statement. So unfortunately for the joint account, that would be required.
All right, great. So I think we've come to the end of our time. There are some more questions, but what we'll allow is you can send in your question to feedback@aibaccessafrica.com, and we'll be able to answer all those questions within the week. But for now, I want to thank our panelists, Paul Mwai and Robert. Thank you so much for your time and for the great session. And I also want to highlight, before I hand over to Robert for some closing remarks, I also want to highlight that you can follow our social media channels. Both Abojani and AIB Access Africa are on Twitter, Facebook, and all the other major channels. You'll find insights there and any updates of any other webinars or any other educational forums, which will be useful for you. And please check out especially the YouTube channel for AIB Access Africa. There are lots of trainings there, trainings on how to use the platform and also other trainings in general on asset classes in the market. And yeah, I'm going to hand over to Robert now.
So thank you very much, Paul and AIB, for this opportunity to share with investors some great insights. And thank you, Naila, for helping us to come up with this. And I believe it was a success. So I want to appreciate all of you who are here. So if you've ever been to Abojani Masterclass, can you please type yes on the chat? I want to see you, because you are the people who have made us from 2018 and will continue growing together. So I believe you know that this is a journey. No one is a genius, and when we are together, we learn and we grow. We make those mistakes and we learn where we've gone wrong and we correct them. So over time, we are becoming smarter. And we usually these days, we have even guys who are working at EABL, KCB, they come to the session and they give us very good insight. So you might find some things are in the public domain, but maybe you don't know the history of the company and the strategies that they're applying. So that helps us, and that is the power of a community. So thank you. Join our Telegram groups, follow us on Twitter. We'll keep updating you with relevant information, and we try to give you timeless information that will matter 3 or 5 years from now, since we know that you are very busy people as professionals and entrepreneurs. So thank you. Have a good day or evening, depending on where you are connecting from. And let's keep interacting in the future sessions. So thank you and bye-bye.